Hello guys, this is Kutesh and welcome to Trademan's YouTube channel. In this video, we are going to discuss 10 questions that every investor should ask before buying a stock. First of all, if you are new to this channel, please subscribe. We publish new interesting investing videos every week. Now, most of these questions can be answered by doing simple research and analysis of the stock. However, for answering a few of them, you might need a little knowledge of how to read the financial statements and how to do the valuation of a company. But if you are new to the financial statements and valuation, you can check out my previous videos in which I have already explained how to value a stock using DCF analysis. And you can also check out my blog trademans.in where I have described how to read the financial statements of a company and how to do the valuation using different tools like DCF analysis or dividend discount model or simply by using relative valuation. So basically you can answer all these questions by doing a simple research of a company. However, it might require a little time and efforts from your side. So let's get started. The first question that you need to ask is, what does the company do? Now, a lot of people invest in the stock market based on the tips or recommendations from their friends, family, neighbor, or just by following the big investors. Dolly is investing in rain industry, so let me also buy the rain industry stocks. However, the first and most important question that you need to answer is, what does rain industry do? Or what does the company you are investing do? What are the products and services offered by that company? What is the business model of that company? How does the business actually make money? Now, while investing in stocks, you are not just buying a stock. Here you are investing in a business, and it's really important for you to understand what are the products and services offered by the company. Similarly, you also need to understand what are the best or top selling products offered by that company. If you see big companies like ITC, they are into a lot of industry. They have their own hotels, they are also in FMCG, and they also produce cigarette. However, the biggest source of income for them is by selling cigarettes. So here you need to understand what are their best selling products and services, because if anything bad happens with their best selling products or best selling industry, it can badly influence the company. So the first and most important question to ask is, what does the company do? What are the products and services offered by that company? Now, the second question that you need to ask is, who runs the company? That is, who are the promoters or owners of the company? Whether it is family managed like Reliance, which is managed by Ambani Group, or it is professionally managed. Some companies like Hindustan Unilever or Colgate, these are managed by professional CEOs who are hired from India or abroad. So here you need to understand who are the promoters or owners of the company. Moreover, you also need to research about their credentials, like what is the background of the chairman or MD or board of directors. Are they capable enough to run the company? Similarly, you also need to read the shareholding pattern of the company, that is how much percentage of the company is owned by the owners or promoters and how much is it owned by the public or the institutions. For example, a lot of big companies like Wipro, more than 70% of Wipro is owned by its promoter, that is Azim Premji and their family. So for those companies which have a majority of the shareholder owned by the family or the promoters, they might be willing to put some extra efforts to make more profits. Anyways, this is just a positive sign. So the second question that you need to ask is, who are the promoters of the company or who actually run the company? Are they capable enough? Do they have the good background and credentials to run that company or not? Now, the third important question that you need to ask is the company profitable? Now, no matter how good is the business model, how good are the products and services, or who is running the company, if the company is not able to make profits, they cannot sustain long in the market. So the third important question to ask here is, how much profits the company made in the last few years? So for finding the profitability of a company, you need to look at the income statement of a company, and there you can look at the gross profit, operating profit, and net profit. Now, if the profit of a company has been continuously increasing over time, then it's a good sign. However, if you find that 5 years ago the net profit was 100 crores and today also in current year also the profit is 100 crore, there you can see that the profit is almost stagnant, so which is not a good sign. Similarly, if the profit of the company is continuously declining, then it's even a bad sign for the company. Now, an important thing to understand here is that in any business there are ups and downs. So in 1 or 2 years there can be losses for a company. However, if the profit of the company is continuously declining over time, then it is a bad sign. So here you need to ask the question, is the company profitable and how much is the growth in the profit for the last 5 to 10 years? Another key factor that you can check here is the profit margin. So how much is the gross profit margin, operating profit margin, or the net profit margin of a company. If the profit margin of a company is stagnant or increasing, then it's a good sign for the company. Now let's move to the fourth question. The fourth question that you need to ask before investing in any stock is, does the company has a sustainable competitive advantage? So Warren Buffett considers sustainable competitive advantage as a mode of a company. So it is something that keeps the competitors away from eating the profit of a company. So sustainable competitive advantage of a company can be intangible assets like brand value or patents, or it can be switching cost. If the customers cannot easily switch from one product to another, then it can be considered a high switching cost. Another sustainable competitive advantage can be low cost. If the company has been able to generate or give the products and services at low cost, then it is again a competitive advantage. And finally, networking effect is also considered as a sustainable competitive advantage. So for few industries or companies like Facebook or WhatsApp, here what you see at that as the networking increases or as the number of users increases, it becomes more difficult for people to switch from that platform to another. For example, you see Facebook here, if all your friends are present or if all your friends are active on Facebook, then you cannot switch to another social platform. And here, because of networking or because of increased user, the moat of the company becomes bigger. So whenever you are researching a company, look for the moat in the company if it has any sustainable competitive advantage. Apart from it, as I already said, brand value can also be a big moat for a company. Companies like Hindustan Unilever or Coca-Cola, they enjoy a big competitive advantage because of their brand value. Now let's move forward to the fifth question. So the fifth question that you need to ask is, how was the past performance of a company? Now in order to understand the past performance of a company, you need to read the financial statements like income statement of a company and the cash flow statement of a company. And here you need to look at the trends, like how the revenue is increasing over time, how is the change in EBITDA, and similarly in the cash flow statement you need to look at how much is the cash from operating activities increasing or how much is the free cash flow of a company increasing. So if the revenue of a company is consistently increasing over time, it can be considered a good sign for a company. Similarly, you can also look at the other financial metrics on these financial statements to understand how was the past performance of a company for the last 5 to 10 years. Now the sixth question that you need to ask before investing in a company is, how strong is its balance sheet? So balance sheet is like a core of a financial statement. For a company which has a very strong balance sheet, it can be a big competitive advantage for that. By looking into the balance sheet of a company, you need to compare the asset side and the liabilities side. If the assets of a company are consistently increasing over time compared to the liabilities, then it can be considered as a good sign. Now there are a lot of things that you can research in the balance sheet of a company. For example, cash, how much the cash the company has, whether its cash level is increasing or stagnant. And similarly, you can look at other metrics also, like the inventories of a company, its receivables, its payables, its intangible assets, and other matrices. For a few industries like pharmaceutical or technology, you also need to look at the research and development feed. That is how much the company is investing in their research and development. Because in these industries, if the company has been able to come up with a new technology or new innovation, they can get a good patent, and which can turn out to be a good advantage for them in future. So the sixth question that you need to ask before investing in a stock is, how strong is the balance sheet of a company? Now the seventh question that you need to ask is, was the management or the promoters of a company involved in any past scam or fraud? Now I'm not very comfortable in giving my money or lending my money to who does not have integrity or who has been involved with any past scams or frauds. So whenever you are investing in any stock, first you need to check at the integrity of a company. Is the company involved with any past fraud action or scams? And further, it is not very difficult to find these activities by doing such just a simple Google search. If you type any company, let's say Tata Motors, search Tata Motors scam or Tata Motors fraud on Google, and if you cannot find anything on the Google search, that's a good sign that the company has not been involved in any past scams or fraud. But if you can find anything catchy, or if you can find that the management or the promoters are cheating their shareholders, then again it's a bad sign for the company, and I won't want to invest my money in that stock. Another thing is you can also check out if there is any past penalty by SEBI, that is the Securities Exchange Board of India. Now, minor penalties by SEBI can be ignored, but if the company has been consistently getting big penalties from SEBI, then again it's a bad sign. So the seventh question that you need to ask is, was the management or the promoters of a company involved in any past scam or fraud? If yes, then ignore the company and move on to research the next one. The eighth important question that you need to ask is, who are the competitors of a company? So here you need to look at the both direct and indirect competitors of a company, and what is the market share of the company compared to the competitors in that industry. For example, if you see the companies like Tata Motors, they are both into commercial segment and passenger segment. In the commercial vehicle segment, they produce buses and trucks, and for that, in that industry they have competitors like Ashok Leyland, Bharat Bench or Eicher Motors. On the other hand, they also produce vehicles in the passenger segment, that is hatchback, sedans or SUVs cars. So in that industry they have competitors like Maruti Suzuki or Mahindra. So these are the direct competitors of a company. In addition, you also need to look at the foreign competitors or any global competitor that the company has. So here you can see that the Tata Motors also face competitions from Toyota or Skoda. So these companies are not listed in the Indian stock market, but still they own a big market share in the industry, and they are also the competitors of a company. So here you need to analyze what Tata Motors or what the company that you are researching is doing differently from its competitors or the other companies in the industry. So this is something that you need to research. What are the competitors, who are direct and indirect competitors? Is there any global competitor of the company, or chances of any big global readers entering that market? So the eighth question that you need to ask is, who are the competitors of the company? So now let's move forward to the ninth question. So the ninth question that you need to ask is, how much the debt that a company has. Now, I'm not a very big fan of debt for a company, and I generally enjoy a company who has a zero debt. However, I understand that in order to grow, sometimes the company has to take debts. There are two options for a company to get money. Either they can get debt funding or they can go for the equity funding. And many a times a company consider debt funding because it is considered cheaper compared to the equity funding. As long as the company is able to maintain its debt level, it's not very risky for a company. However, if the debt level of a company is beyond payable, then it might not be a good sign to invest in that company. So before investing in a company, you need to check the debt level of a company, that is how much is the short term and long term debt of a company. And you can find this information in the balance sheet of a company. In order to understand whether the company will be able to pay those debts or not, you can look at the income statement and cash flow statement of a company. If the company is generating enough profits, or if it has enough free cash flow to pay all its debt within 3 to 5 years, then again it's not a big deal and it's not a big warning sign for the company. However, if the debt level of a company is beyond payable, or if the debt level of a company is too high, then again it's a bad sign for a company. Now, along with the debt, another important thing that you need to check is how much is placing of the shares by the promoters. That is how much shares company or the promoters has placed to any banks or other institution to get some loans. Now, placing of a share is never favorable for a company, and if you can find that the promoters has placed a majority of their shares to other institutions, then it might be a warning sign for you as an investor. And now let's move forward to the 10th and the final question. So the final question that you need to ask is, how is this stock valued? As Warren Buffett used to say, a good business is not a good investment if you overpay for it. So no matter how good is Maruti Suzuki Swift Desire, if you are overpaying to buy that car, it's not a good deal for you. So similarly, in the case of buying a stock, if you are overpaying for buying a stock, then again it's not a good deal for you as an investor. So here you need to find the intrinsic value of a company using different tools like DCF calculator or dividend discount model, and arrive at what is the true intrinsic value of a company. And if the current value of a company is lower than the true intrinsic value of a company, then it might be undervalued and a good opportunity for you to buy that stock. On the other hand, if the stock is currently trading at a way higher compared to the current price, then it might not be a good opportunity for you to enter that stock, and it would be better for you to wait for the stock price of that company to go down so that you can buy that stock in future. And now there are various tools to find the valuation of a company. For example, absolute valuation or relative valuation. In relative valuation, you can use financial ratios like price to earnings ratio or price to book value to find out whether the company is currently overvalued or undervalued compared to their competitors or their industry. And you can find a lot of valuation tools like DCF calculator, Graham calculator, and fair value calculator on the TradeBrains website. I'll add a link to all these different calculators in the description. Now, the market gives an opportunity for every investor to buy stock at least 1 or 2 times in a year. So in such scenarios, when the stock is overvalued, keep that stock in a watch list and wait for the price to fall. So these are the 10 questions that you need to ask before purchasing any stock. The first question was, what does the company do? The second one was, who runs the company? The third is the company profitable? The fourth question that you need to ask is, does the company has a sustainable competitive advantage or moat? The fifth question that you need to ask is, how was the past performance of a company? The sixth question that you need to ask is, how strong is the balance sheet of a company? The seventh question that you need to ask is, was the management involved in any past scam or fraud? The eighth question that you need to ask is, who are the key competitors of the company? The ninth question that you need to ask is, how much the debt their company has? And lastly, the 10th and final question that you need to ask is, how is the stock valued, whether it is undervalued or overvalued? So that's all for this video. I hope it was useful to you. If you liked it, please hit the thumbs up button and subscribe to this channel for more interesting investing videos. This is Kritesh signing off.